Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and today I'm going to be doing a live video talking about Index Universal Life and the different types of policy loans that are available. I think this is something that's been coming up a lot lately, and I actually had somebody make a very specific request and make a very specific comment in the video that I launched that video yesterday. Been getting a lot of good feedback on it and a lot of great questions. And this question and some of the comments that I've been getting from people have to do with the loans and how do Index Universal Life loans work? Because a lot of people are saying that all of my conversation about the indexed or participating loans and the risk associated with the indexed and participating loans in retirement, none of that matters. That's what a lot of IUL agents are saying, is that none of that matters because of the fact that you could just do a wash loan. And in doing, hey, what's up, Seb? But in doing a wash loan, it actually injects a lot of other risks inside of IUL. And it's one of those topics that can get pretty complicated. I tried to do a response. And so let me just kind of read through the comment really quickly. So I have it really clear about what the question is, and everybody's on the same page and we're all speaking the same language. And I'll basically read the comment and then I'll read my response, and then we'll be able to go from there. So let me just zoom right in here. So this is the comment. It said, thanks for the explanation for IUL. I have a question about the loan of IUL, and I think none of the agents will give me an honest answer but you. They always say the IUL loan is zero net wash. The loan interest says 3.5%, and the insurance company will give you 3.5% credit. Therefore, the loan interest technically is zero. So that sounds great, but there must be some hidden detail they just don't tell. If that is the case, then why not all people borrow the money and put the money in CD or other investment to get positive arbitrage? If you already have a video on that, please provide a link. The answer is I think I do have a video on that somewhere, but I've got over 1,000 videos on the channel now, and I just couldn't find it very easily. So we're just making a new one because that's what we do around here. So I wrote, somebody else wrote and responded. So a wash loan does not result in positive arbitrage. Yes, you could put money in CD, but people put money in whole life or IUL for potentially to get a higher than CD rate, especially with tax advantage, while still very much able to access the money through lifetime. Aside from the fact that the English and the grammar here is really poor, we're gonna keep going. So then I wrote, with IUL, there are two loan options. With option one, you have the index or participating loan option. This has a variable loan cost, but allows you to have upside potential because you participate in the index. This is how most illustrations are run when income or loans are taken against the policy, because it is able to be illustrated with 50 basis points of positive arbitrage. It makes the illustration look amazing, but it's not how they actually work. And so that was my response, and that is how index loans work. I'm gonna get more into detail on this. I've got my board back here, and I've got an illustration up that I'm gonna utilize as an example to kind of to lean on and show what I'm talking about, talk about what I mean in greater detail. Option two is the fixed or wash loan. This will be a fixed loan rate and will also have a fixed crediting strategy in the policy that washes out the costs. That's why a lot of people call it the wash loan. The problem with the wash loan is that it is not eating into the net amount at risk in the insurance. Therefore, every year the cost of insurance gets higher and higher. Those charges will eat into the cash value over time, especially in retirement, when most people are using these loans because of cost of insurance is getting very expensive and the annual renewable term charges are increasing. That help? Question mark. And then he said, thanks for the prompt reply. Still don't fully understand how this works. Isn't the insurance company giving the credit, or do you mean the credit won't catch up to the COI increase rate? And so rather than go back and forth on this response, we are just doing this video here, and so that is what it is. So I'm looking down here. Let's see if anybody has any questions as I'm going through this. Feel free to engage, ask me anything you have to do with any of this or make any comments, I'm happy to engage, happy to obviously provide as much feedback. The reason I'm doing this is because I want to provide as much value and as much understanding here. I obviously, when I make these videos, I do so through the lens of trying to communicate a point and a principle. But I also, sometimes it's hard to see the forest through the trees for me because I know this stuff on such a different level that sometimes I go over certain points that maybe you have questions on. So as I'm talking about it, if you feel like I'm breezing over a certain element of something that needs to be communicated, just let me know and I will do my best to make sure to include it. So let's go from there. So let me do this. I'm going to share this. This is my screen. I've got my policy up here. This is the Allianz. What is this here? This is the Allianz Pro Plus Advantage Fixed Index Universal Life. This is an illustration that I used for a previous video I don't know who it was for, but like I did this video just to kind of show the danger of loans and the danger that these policies have and the potential they have to blow up. And so I figured it would be a really good place to start to talk about the different types of loans. And I think to be able to get into the real explanation of the different types of loans, what is really, really important is to discuss how the crediting works, how the loans are impacted, how the illustrations look in relation to the loans and the expectation around these loans. And then we can kind of work our way into understanding all the other elements of the loan features, whether it's the fixed or the index loan that we're utilizing, the participating loan, depending on the company that you're utilizing and what they call it. We can go from there. So that said, let's get into this. I'm going to try to use some highlights here so I don't draw over everything and make it look tough. So here's something to understand. When you're running this illustration, as we're looking at this Allianz Pro Plus Advantage, there's a current scenario, and the current scenario has a 6% assumption, and the alternate scenario, that is a 5% assumption, okay? So I think one of the things that's really fascinating to understand is that there's really only a difference of 1% between these two things, right? There's only a 1% difference. So think about this. And this is really vital for everybody who's interested in Index Universal Life to understand, because of the fact that when you look at this difference, a lot of people would say, well, it's only 1% difference. How much of a big deal could that make in the policy? Well, the answer is it's monstrous. And the reason that it's monstrous is because when we get into the later years of the policy, you know, these years and beyond, to the next page, and we'll go there, what happens is the cost of insurance and all the charges inside of the policy, because of the annual renewable term, they get higher and higher and higher, okay? And so what we have to look at is we have to understand the different variables that go into that. And the biggest thing, one of the biggest variables that goes into it is the annual renewable term. And the annual renewable term is the difference. It's basically the cash value column, I did that backwards. It's the annual renewable term, so the annual renewable term is like creates the net amount at risk, okay? And the net amount at risk equals the death benefit minus the cash value. And that will equal a number. And so just to give an example right here, what do we have? We have the cash value here is $658,000 and the death benefit is $1,198,096. And then we have the cash value is $658,230. Okay? So when we look at these numbers, you know, we got, what do we got? 7, 10, we got 8, 1, 4, 541,000. So the net amount at risk is $541,000. I'm showing you this because this is what the cost of insurance is based on, okay? And so what happens here is that when the 5% number is even though it's only a 1% less than the 6%, what happens is that increases the spread between the death benefit and the cash value. You can see here, just as an example, you only got 603 there versus 867. So it's not just a matter of looking at 603 versus 867. It's a matter of that extra $264,000 of net amount at risk that increases the cost of insurance, right? And when that cost of insurance goes up, those charges, you don't see it on here, but those charges eat into this policy. And then when you look at the fact that this policy is taking loans for income right here, then you also have the loan interest that is not shown on this page. It's shown on another page later, and we'll get into that because that's one of the entire points of this video. But when you look at this, that's where these things really start to blow up. And so these little minute differences of 0.5% here, 1% there, they compound against you because of the internal fees and charges and this net amount at risk concept that goes into everything. So if everybody's keeping up with me here, please just let me know that you understand this or you don't understand it, or you give me more questions, because this is an extremely complicated concept, but this is exactly why I love talking about this stuff, because my passion against IUL really has to do a lot with the fact that they're sold as a very simplistic product, and in fact they are actually a very dangerous product. So once again, I have notes all over the place here. I need to find the right pages for all this. All right, so this is a good place to go. I'm gonna close that. I'm gonna erase a lot of this stuff so I can kind of start over because this is all from my last video and I wanna focus on something completely new. These are my notes from my last video when I was doing it, so we're gonna just do this over again. So now what you see here, this is what we were going to before. This is an illustration using the index loan, okay? Now why do people show the index loan? The reason that most agents will run the illustration showing the index loan is because it allows you to do 50 basis points of positive arbitrage, right? And so when you look at the 50 basis points of positive arbitrage, that allows this, like what we're looking at here, that allows this to go into perpetuity. So one of the things that I want you to look at, and this is really, really fascinating to kind of take into consideration, is that, and I'm gonna have to go to a different page to really show it out, but you see here we have the loan starting, and by the time you're 67, you've been taking $77,000 of income, but you got 1.32 million of indexed loans that have been taken. But then you have the outstanding loan balance here is $2,061,000. So you've taken a total of $1.32 million of loans, but you have 2.061 million of outstanding loans on the policy. Now, here, the other thing to look at here is that when you first started, you had $907,000 of cash value, net cash value, even with the positive arbitrage, which if the positive arbitrage was pure and you were making money every year, then the cash value would still be going up, right? But it's not, because they're working your cash value down, and your net cash value is basically, so your net cash value here, once again, is the accumulated value minus, I'm gonna write this out, the cash value here on this equals the accumulated value minus loan costs, right? And that is what and how this works. And so when you look at this, and when we look at these numbers, and we realize, holy crap, we have only $555,000 of net cash value there, and then it gets even crazier, because I'm gonna go to the next page, and you can see this page I spent a lot of time on in the last video. I'm just gonna erase some of this so I can focus on a couple really big concepts that I really think it's important for people to understand here. Once again, I'm just kind of going off of just my knowledge here. I didn't prep for this. I'm just trying to take this and teach a concept. But one of the things that we have here is that you could see here that you're taking the 77,676 of income. The loan amounts go up every year. What's happened here is that the outstanding loan balance, by the time you're 77, you've taken just over $2 million of loans, but you have 4.361 million of outstanding loan balance. Now, what I can do here, and I'm gonna do this just because I think it's really important to do, I'm gonna go back. So I'm on page 34 now. I'm gonna try to go back to the illustration and find the right page. I think it was page 28 maybe that I was on because I was just writing on it. Let me see here. So on page 28, no, page 29 I'm gonna go to because this is the current assumption category. You could see at 77, the accumulated value, which is really important to see. The accumulated value there was 4,787,000. 4,787, okay? So now I'm gonna go back, 4,787, I gotta find, oh boy, 30, was I page 35? Nope, I wasn't, I was here. Okay, on I had 4,787,000 is what I had for accumulated value. I'm gonna write that down, 4,787,000 and then change, but I'm just gonna zero it out there. So here's the deal. If you look at this, this is the total accumulated value that is in there. But now this is what allows you to kind of create this income of 77,000 every single year. They're basing it off this, and they're basing this 77,000 on the fact that you're gonna have positive arbitrage every year because we were able to do that 50 basis points of positive arb, right? This is how they illustrate so well, but this is why I'm so adamant that these things will never perform as sold, because when you really get into this, this is how this works. And it's like complete insane asylum stuff to me, because when you look at the math, it just doesn't work. So now what do we have here? We have the accumulated value, but then we have the outstanding loan balance, and that's 4,361,488 is the loan balance. So I don't have the exact numbers here, but that is what equals, and just do the math because I zeroed this part out a little bit. I didn't remember the exact numbers, but that's what equals the 426,291 of net cash value. This is what matters. Now here's the crazy part. So this is done, and remember, this is showing positive arbitrage of 50 basis points every single year in the illustration. But let's just say that at 78 years old, there's a 0% year, which, by the way, if you're in retirement, there's about a 25 to 30% of the time, 25 to 30% of the years, you're going to have a year where the return is less than the cost of the indexed loan, okay? And I promise you, I'm getting to the concept of the wash loan, but I think before you understand the wash loan and the risks inside of the wash loan, you have to understand the risks of the traditional way that IUL is sold, which is through the participating or index loans. So I think it's important to understand both sides of the pendulum and the risks on both sides of these things. And so what do we have here? We have $426,000 in net cash value, but here's the deal. We have $4.3 million of loans. Those loans have to be paid from the policy because you're not paying any premium anymore, right? Like you have no more, like it's not on this page. You have no more premiums coming into this policy. Everything has to be self-sustained, and it only works because of this 50 basis points of positive arbitrage. And so then what happens is when we have a negative year, that puts stress on the policy because of the $426,000 of cash value, but it's $4 million of leverage now that is putting stress on that $426,000. So now let's look at this. I'm gonna pull this up. Check this out. I'm gonna run some math. I'm gonna do some simple math here, and I'm gonna run at 5%. 4,361,488 times 0.05. So you have, this is insane. The interest expense alone, because on a negative year, the interest on this 4,361,000 has to get paid. That interest is $218,074. Okay, is the interest. So everybody says that these things are great income vehicle distribution tools. Curtis Ray does this all the time with his MPI garbage that I hear about all the time. And the bottom line is, when you look at this, 426,000, like 218,000 is more than a 50% loss on the net cash value, because it doesn't show it here because it's showing that 50 basis points of positive arbitrage. But one negative year here, you're going to lose 50% of this net cash value. And 2 years, and now all of a sudden you have a policy lapse issue and you are out of money, and all of this income that you're seeing goes away. That is how the index loan option works, and that is where the risk in these index loans are. And this is why I always say with Index Universal Life, it's not a matter of what the risks are inside of the policy during the accumulation years. I've got a lot of different videos, different content that focus on educating people about IULs and the fact that they don't perform the way that they're illustrated because of all the facts that they just show these pie in the sky, artificial, nothing but positive year results when it doesn't work that way. And that's why I created the IUL challenge, to show that even in the accumulation years of an IUL, that they're not going to perform the way that you were sold that they were going to perform. But that said, let's say I was wrong on that. And let's say they did exactly what you thought they were going to do, and you would get to retirement, and then you had to lean on them for retirement income through policy loans. This is the reason. What I just showed you is exactly the reason that they are completely dangerous. Now that I've covered the index loan options, this is really important to understand. Let's talk about the wash loan options. And so I don't have a wash loan written up here, but what I want to do is I'm going to erase this, because I think it's really, I think everybody gets the point. If you need to watch a replay, go back. I'll make sure the replay on this is live and available for everybody who wants it. And we'll go from there. And I'll probably, I don't know, I may just turn this into a different video for people to watch as well. I may do a more refined video on this just to get the concept across as well. So let's just say we do a wash loan. So this is going to be, I'm going to have to write this out and really explain it to people, because here's the deal. The idea here is saying, all right, the loan credits. So right here with an index loan, I didn't show this really well, but you have the loan charges and the loan credits, and you can see the loan charges and the loan credits are different. The loan credits are higher. This is the positive arbitrage I'm talking about right here. These loan credits are higher than the loan charges. That's the 50 basis points of extra credits, and these are what make it work. Now, if we were to show this in a wash loan, these two numbers would match. That's it. The loan charges and the loan credits would match, and that is, you know, that in a perfect world, that's where people say, okay, that's the power of the wash loan. And Chris, all you're talking about, the index loan risks, even if they're real, you don't have to worry about it, because we could just do this wash loan and it solves all the problems. And I'm gonna try to show by going over here as we get into this. I think this is the page I was working on before. It is. I'm gonna erase all this and I'm gonna start explaining the challenge there. Now that you saw that loan page and you understand kind of how that works, let's discuss the wash loan over here, because this is extremely important, right? So here we go. What we have is the net cash value. Let's see here. So you could see here the net amount at risk right here. We start taking these loans, and you can see as soon as we start taking the loans, we have the accumulation value right here, and then the cash value, they differ, right? And then we have the loans over there that are what they are. But and if we think about the wash loan element of this, what we always have to be thinking about is the net amount at risk. And this is the danger in wash loans, because remember, the net amount at risk is always what leads to the charges long term. So this is the danger in the wash loans, is understanding how they impact the net amount at risk. And if you don't understand how they impact the net amount at risk, then you can't really understand kind of what your money is doing for you. So what we have here is the death benefit right out of the gate is $1,709,000. $995. That's the death benefit. Now the cash value is $887,666. Okay, so I minus these out and I go 9, 2, 3, 2, 6, 10, 2. So you have 822,000 of net amount at risk. And this is what the annual renewable term charge is going to be based on the age of 51 years old at that time. 51 years old and 822,000 and whatever the health rating is for this person. And then you can basically figure out what the charge is for that. And so as we go down through here, what's going to happen is you can see the net amount at risk. Remember, I went down through and I did this, and the net amount at risk later in the policy before was $400,000, right? It was like $426,000, I think, was the net amount at risk, utilizing the example of the index loan earlier. And that's because even though the accumulated value, or even though the cash value was going down, the death benefit you can see is going down as well. It's getting eaten into but the problem is the accumulated value is going up. The loan value is getting impacted in everything, which is impacting the cash value. But at the end of the day, what's going to happen here is the wash loan is not going to eat into the net amount at risk. So this net amount at risk will remain very level. And what's going to happen is typically when you do the index loan and you have a level death benefit, the positive arbitrage on the illustration is going to show it looking very, very positively, and it can have this illusion of reduction of net amount at risk. And not to say that the reduction of net amount at risk can't happen on a year in, year out basis, but it's just not a predictable result over a long period of time due to the fact that 25 to 30% of the time we're going to have negative performance years. And so that is the problem. So now when we have the wash loans, this is the problem. This $822,000 here, that 822 remains, I'm just going to do 822,000 of annual renewable term. This remains the insurance number that we're going to have to meet. And the problem is you're 51, then you're 52, then you're 53, and then you go all the way down until you're, let's say, 75. And this number really remains what it is because the wash loan isn't eating into this. So then what happens is the money that you're paying for your annual renewable term at 51 goes up and up and up. When you're 52, 53, it gets more and more expensive because the whole idea and the way they sell this is that this 822 gets less and less and less, and your net amount at risk goes down, so therefore your insurance charges goes down. As soon as you use a wash loan, that sales pitch goes out the window. So it's important to understand that they speak out of both sides of their mouths, these IUL agents. They speak out of both sides of their mouth. And this is the challenge with this. I showed you at the beginning, if you use the index loans, where the risks are, and those risks are catastrophic, right? Like they're absolutely atrocious. Then they go, well, if you don't like that risk, just do the wash loan. And they don't explain the risks on this side. And the risks on this side is that if you go the wash loan, a lot of the ways that they said that the problem is solved with the net amount at risk on the index side, that goes away. You don't have that benefit. Now you have the net amount at risk that remains there. The wash loan maybe takes the loan risk off the table, but now you have the cost of insurance risk that gets re-injected into the policy, okay? And so that's where we look at this now and we go, whoa, okay, by the time we're 75, like with $822,000, that's double the cost that we were dealing with before. And by the way, those costs are gonna be like much more exponentially growing between 51 and 75 the whole way down. And so this thing will blow up based on the internal cost of insurance and admin charges that are associated with this extra death benefit that comes along with it. And therein lies the problem. And that's why I tell people, no matter what, no matter how you slice this, because of the fact that the variables inside of an index universal life policy are not not under your control, and they're going to move, and they're not going to move in your favor. And it's not like the insurance company is trying to stick it to you and make more money either, by the way. A lot of people think that the IUL company is going to try to change these levers so they can be more profitable. No, they're just trying to like manage the risk of it all. And the risk is that you just are utilizing this tool that's being sold as something that it's not really designed to do. This whole idea of tax-free income looks great on an illustration, but the bottom line is like it should never be utilized as a primary income vehicle. If you're relying on income from an IUL every single year, the sad truth is you're going to run into problems. And the problem there is if this happens and this blows up before you're 75 years old, which there's a really good chance in a policy like this that it will blow up and have a lapse issue by the time before you're 75, then the overloan protection rider typically doesn't kick in until you're 75. So you actually potentially have a really, really ugly tax consequence that you're going to be staring in the face. And if that happens to you, you're going to have a whole different set of problems that I don't know how you're going to deal with that. And so anyway, that is how the wash loans work versus the index loans, and where the dangers are on both sides of the loan perspective for index universal life. I get agents that talk about this all the time that try to tell me that I don't understand, that wash loans will solve the whole problem. But the bottom line is wash loans just inject the cost of insurance risk back into the equation, and that will end up causing all sorts of problems as well. This is the reason that people run the illustrations with the index loans, and then they just say, hey, no, if you don't like it, you just run wash loans. If you want to see how it works, have an illustration run comparing an index loan option versus a wash loan option and see how the policy performs, right? Just see how it performs. And you're gonna see that your income that you're assuming you're gonna get, like this showed 70-something thousand, you're gonna see that that income would drop from like 77,000 all the way down probably into like 22, 23, 24,000. It's a huge, huge difference. And so, and the problem is once you start and you have these loans and you have all that happening, it can get really ugly and it gets really fast. And by the time you realize that it's a problem, it's almost too late, right? Or it is too late. And this is why I have a passion against this, because most of the time people are not gonna realize that they even have a problem with their IUL until it's too late. And that's why I spend so much time. A lot of people ask me, Chris, why do you have to create so much content hating on IULs? Why can't you just focus on whole life? I would say, well, the answer is I focus a lot on whole life, first of all, because I love it and I believe in it. But secondly, because there are a lot more index universal life agents out there that are misrepresenting it, and there's so much bad information out there, and I just feel obligated because I think I feel obligated to share the truth, because I think there's so many people that are doing it the wrong way. And I think the ripple effect and the trickle down effect is there's going to be regulatory backlash that's going to impact whole life insurance, and all the people that are doing it the right way, it's going to impact us negatively because of we got hundreds of thousands of untrained, uneducated IUL agents, good intentions aside, because I do believe a lot of them believe they're doing what's right and they're trying to help, but they just don't know what they don't know, because the training is top down from the carriers, and the carriers are not teaching, the insurance companies are not teaching the real nuances about how these work. When I was a director of business development for one of the top IUL companies in the country, this is the stuff that I learned. And when I first really started to discover this, I remember how I felt. I remember thinking to myself, no, there's no way that could be the case. How would an insurance company do this? It doesn't make sense. These companies would never do this. If they would do this, there's no way they would be able to get away with it. But the answer is just look back to universal life, traditional universal life that was created in the early 80s. And if you look at how the companies managed that when all those policies had challenges in the declining interest rate environment and the fixed crediting strategies, and then you look at all the policies that had all these lapse issues and taxable consequence issues, and you look at how the insurance carriers and the companies handled those policyholders, they didn't look out for the policyholders' best interest, they looked out for the company's best interest. And that's just what these companies do. And I think IUL, we're gonna have a traditional UL kind of 2.0 situation coming once they evolve and once they mature a little bit more. And the proof will be in the time that comes behind it all. Obviously, I inject a lot of my opinions into this. I have no problem acknowledging that that's the case, but my opinions are based on a lot of fact, a lot of math, a lot of experience, a lot of insight, a lot of conversations with high-level people, and just really, really understanding this. My opinion, obviously, is that the world is going to go a certain way, and I believe that to be true. But if the markets are going to be a little more up and down over the next decade, and we're not about to experience another bull run like we just did, then that doesn't bode well for IUL. And I think it's going to be many days of reckoning that come to the foreground for a lot of these IUL agents. And I think, unfortunately, a lot of people are going to be looking at this a couple of years from now and being like, wow, I wish I had listened to Chris a couple of years ago, because the truth is the truth. And I think, time is going to tell. And I think I'm on the right side of this. So yeah, Travis, you're welcome, man. Like, this is one of those topics. I just think it's so important. You're not the only one that's asked this question. I get asked this question all the time. I have comments. I have agents that try to fight me on this, that tell me I don't understand it. But it's mind-numbing to me that they don't understand it. Like, I don't see how. I'm the kind of person that's always looking deeper, right? Like, I'm always trying to disprove why I believe what I believe. Like, I want to be like devil's advocate against everything I believe to be true. I'm always trying to be on the other side of the spectrum. And so it's mind-numbing to me, the level of what do they call it? Bias, the perspective bias, or whatever the word. I can't but you know what I'm saying? Like, the people that have this bias towards what they're going for, and they're trying to get it's confirmation bias. They're trying to get the confirmation of what they believe, and they just find all the information that focuses on that. I kind of operate the opposite way. Whatever I believe, I'm trying to find the holes in it and whatever. And I guess that's why I stopped selling IUL. I mean, I sold IUL for 4.5 years before I went away from it, and before I started becoming a staunch, adversary against it. And I guess that's one of the reasons I create the content that I do, because I want to. It's for the people who are looking to buy policies potentially, but it's also for the people, and I'll say this, it's for the people that are looking to buy a policy, because I believe so much in the power of whole life insurance and cash value life insurance and what it can do for you. But I believe it's got to be whole life insurance. And I think the IUL industry has basically taken all the goodwill and reputation that whole life has built over 180 years, and they're bastardizing it, and they're making it their own. And they're just twisting facts to their benefit and trying to make it look like all these people have utilized IUL for all these reasons, when in fact these people have used whole life for all these reasons, like Ray Kroc and J.C. Penney and Walt Disney. All those stories that people are utilizing, saying IUL, people are saying IUL, that they used IUL for this. They actually used whole life, not IUL. And that kind of stuff happens all the time. So I love educating people that are looking to buy, because I just think I want to be able to help you make a better decision. But I'm also looking to reach agents, probably more than anything. I think that's where my greatest impact is reaching agents that kind of have this awakening. And it's why I have the IMO. That's why we launched the IMO, is really to rescue IUL agents to go out there and do it the right way. So if anybody's an agent that's watching this that wants to reach out, you can go to life180.com, set up an agent interview, and you can meet with my hiring manager that can kind of guide you through an interview. Follow-up question. You assume that a person never pays back. What if the person pays back the money after a couple of years? So there's still a lot of other risks inside of an IUL. We're just talking about the loan risk inside of the IUL. There's other risks inside of the IUL that I have a lot of other videos about on the training playlist. I think I would go watch that training playlist and check that out. I would also say, if you plan on paying the money back, then we're not talking about a retirement income conversation. We're talking about maybe utilizing it for a real estate investment, for a business investment, something of that nature. And if you are utilizing it in that way and you plan on paying it back, obviously it mitigates that risk, it reduces that risk. But at the end of the day, the challenge here is that IULs are sold as a tax-free income retirement vehicle. So if you're taking this money out for retirement and you have no more cash flow, I don't know how most people are going to be paying that money back. And then on the flip side of that, I would say, if you're planning on paying the loan back, once again, whole life is just a better vehicle, because early on in a policy, like I deal with a lot of real estate investors. That's like probably our #1 market that we serve. And so we deal with a lot of people that are looking for high liquidity early. They want to leverage that money for real estate. They want to borrow against their policy, put it into real estate, use the cash flow from the real estate to pay back the loans. And we create this kind of infrastructure where they can do that, and it amplifies the growth of their cash, and it increases their control of their money. So when we look at that from a whole life policy, it works really well because we can create literally 90%, 92% liquidity in some situations year one. With an IUL, because of the surrender charges, it's almost impossible to do that. And so, and when we look at a lot of these IULs have typically 10 to 15 year surrender charges. With whole life, there's no surrender charge if you design it the right way. It's just the insurance charges and the admin costs and the fees, which IUL also has, and they both have their own thing. Then you start to realize, depending on what you want to use a policy for, whether it's tax-free income or whether it's utilizing it as what I would call cash flow hacking, utilizing the cash early in the policy to invest in other assets and leverage and borrow against for other assets. No matter what you're doing, it just makes sense. Whole life wins every time. If you give it enough time and you do enough research, whole life will win every time. The people that say IUL wins are only the people that look at the illustrations like the one I'm showing you, and they say, well, it wins on paper. And I'm not going to dispute that. Like, I won't. I sold them for a long time. I get it. I know how the game works. Like, illustrations don't matter. If these IULs worked the way that everybody's saying they did, then I would still be selling them. I would own them. I wouldn't have 1035 my money out of IULs into whole life policies. I don't know what to say to that. Like, anybody that believes in IUL hasn't been doing it long enough. That's my general consensus. And if you're selling IUL still, and you've sold it for a decade or more, and you've had a decade of annual review meetings with your clients, and you're able to sleep at night and still sell this, well, I don't know what to tell you. There's a place for people like you, in my opinion. And I stand very strong on that opinion. And I know I've built a lot of non-friends over that opinion for people that, think I'm a little too verbose, in my opinion, and are a bit too hard-lined, I guess, in what I do. But I just believe that what we do as insurance agents and the ability that we have to impact people in a positive way should not be taken lightly. And I think going out and putting people in a product that isn't really designed to do what it's being sold to do has the potential to harm people in such a way that you can't even put words to, and you can't even put the math behind it. It's literally going to decimate people's future. And I think that's extremely important for people to really wrap their heads around. And so anyway, that is it. All right, I'm gonna give it a minute. Anybody have any other questions? And then I'm gonna sign off, and hopefully you found value in this. Hopefully this was helpful. I would encourage everybody to go back and watch this, and like the math behind it is really, really important. Once again, you gotta understand the policy structure. You gotta understand the different types of loan structures, the different risks inside of the participating or index loans, the different risks with the wash loans or the fixed loans. And once you do that and you understand the different levers that get moved inside of the IUL policy, remember, all the levers in that policy are all designed to always shift the risk to the policyholder, not to the insurance company. Once again, that is a fundamental difference and reason that I like whole life, not IUL, because the fundamental design of a whole life policy is to have the insurance company hold all the risk. IUL shifts all that risk to the policyholder. And so that is what it is. So anyway, that's it. Hope you guys have a blessed and inspirational day. We'll talk soon. See ya.